If you own a property or rent in the UK, you've probably noticed that rents are skyrocketing over the past few years and things are about to get a whole lot worse. The simple explanation about why this is happening comes down to basic economic theory. Housing supply has decreased, meanwhile, demand has actually increased, ergo higher prices. But here's the crazy part. Even though rents are increasing, many UK landlords, like myself and many others I know, are still choosing to leave the UK property market, further constricting supply. The first major signal of this was back in 2022, when the Section 24 law became fully operational, meaning that only 20% maximum mortgage interest was deductible for private landlords, and things have only gotten worse since then. Over the past 3 years, £79 billion of private rental value has been wiped off. And as for the landlords still holding, many are simply stuck. And the ones who moved, they're in markets that are actively competing for capital. In regions like where I am, Vietnam, Thailand, and UAE, and recently Saudi Arabia, which now allows foreign ownership. The reality is, professional capital reads policy decisions. So I'm going to tell you about some of the places where this capital has been moving to. And if you're a high rate taxpayer and real estate owner in the UK, and you spent the past 18 months ignoring what's coming, then this is really crucial for you. So let's break it down. On the 1st of May, 2026, Section 21 will be formally abolished. Every existing AST, assured short-hold tenancy in England, is automatically converted. So if you're running a periodic tenancy, there will be no fixed end date. If you want your property back and your tenant doesn't want to leave, you're going to have to go through the courts pretty much every time without exception. So that's the headline that everyone's been watching. But here's what's been buried. MTD, Making Tax Digital, is now live for landlords earning more than £50,000 gross. That means you're going to be reporting to HMRC quarterly, not annually. Therefore, your administrative load just quadrupled. As to capital gains tax on residential properties, it's 18% for basic grade and 24% for higher grade. That's your exit tax, baked in whether you plan for it or not. And then there's the EPC Level C requirement by 2030. It's not a proposal, it's a target with teeth. Industry estimates state that it is going to cost an average of about £30,000 per non-compliant property just to stay legal. And there's going to be fines for non-compliance, up to £30,000 per property on top of that. In 2025 alone, the UK private rented sector actually contracted by £48 billion. That's the Savills data that was recently published. 3 consecutive years of contraction and total $79 billion gone from the sector since 2022. This is not a market failing. This is a market reading the government correctly. So now let's apply this to the 2026 reality. You've got Section 24 mortgage interest relief that's basically just capped at basic rate. If you're a higher rate taxpayer, you're essentially paying tax on income you never even receive. Plus you've got maintenance, voids, letting agent fees, and compliance costs. And you've got the quarterly MTD filing burdens. That's time is money. Practically speaking, your net yields could be well under 3%, and that's before you factor in any EPC upgrades you're going to have to do. A bloody savings account pays more than that, with minimal operational risk. The only reason to hold at this stage is betting on capital growth, which in this economic environment in the UK is pretty far-fetched. So here's the big question. Where does liquidated UK capital go next? Because capital is moving and so are the people. 2025 saw the UK's largest recorded exodus of wealthy Brits leaving the country. And in 2026, it's expected to be even more. In the region where I live, you've got Thailand, Indonesia, Malaysia ranking in the top 20 countries now that British investors buy property. And even Vietnam, Cambodia, and Philippines are in the top 25. Each year, these figures increase and increase. So here's the interesting part. If you don't know this already, foreigners can actually own freehold condominiums in Thailand with the same legal title as a Thai national, as long as you're within the 49% foreigner quota per building. And lots of Brits are taking this up, whether it be for retirement or as investment. Quality life in Thailand is fantastic, and it is a much lower cost of living. And it's low tax. Just a little warning, any agent trying to sell you a 30 plus 30 plus 30 year lease on a landed property, the Thai Supreme Court effectively voided these structures. So extensions beyond the initial term are personal promises and they are not enforceable contracts. Beware. As for Indonesia, and particularly Bali, which attracts a lot of foreign investment, this is where a lot of foreign buyers get into trouble, because you cannot own hak milik, freehold, as a foreigner, full stop. And anyone telling you otherwise is just wrong. What you can get is a leasehold agreement, hak sewa, which is typically 25 to 30 years with extensions up to a possible 80 years. Or if you're establishing a PTPMA, a foreign investment company, you can have hak pakai, which is right to build. It's a longer tenor and you get a little bit more control, but it's administratively more complex. However, if you do structure things well, you can genuinely get some much higher yields. Just remember, you're looking at a short-term leasehold. Malaysia is actually where the structures get clean again. You've got English common law roots, an enforceable title, and one of the only markets in Southeast Asia where foreigners can genuinely and easily own freehold landed property. Not a lease, not a nominee, not via a company, proper freehold registered in your name. Just remember there's a minimum buy-in of 1 million ringgit, about £170,000 at current exchange rate. And the yields are not so attractive. However, if you are looking at residency or retirement, you have the MM2H visa options, which are extremely generous. And remember, Malaysia offers a territorial tax system, although it is moving to a remittance-based. Either way, it is generally considered a low tax jurisdiction. Just always check with your tax advisor first. As mentioned, there's 3 more markets where British capital is moving rapidly. We'll start with Phnom Penh and Cambodia. It is generally considered to be the highest yields in the region, gross. And you can own freehold via the strata title with condos as long as you're above the first floor. The entire market runs in US dollars, so sterling to USD conversion largely neutralizes currency risk. The trade-off is liquidity, expected 12 to 18-month exit, and the yield reflects that. As for Vietnam, we at Rumavi are getting a huge amount of interest for foreigners looking at investing in places like Ho Chi Minh City, Da Nang, and Hanoi. But just remember, for foreign ownership, it's capped at 30% per building, and you only get a 50-year leasehold, which is renewable for another 50 years. Philippines is another location that foreigners can own freehold condominiums up to a 40% cap. Just make sure you understand the condominium corporation rules before signing, because they vary per building and they govern your rights as an owner. So stepping back a bit, here are 3 things that are going to hurt you if you're unprepared. First is liquidity. Most of these markets are not as liquid as you'd be expecting in the West. And if you're planning on exiting in a short period of time, don't even bother. It's probably going to take you minimum 6 months up to 18 months to find the right price for your unit. Second is leverage. If you're coming from the UK or the US and you're used to being able to get a 70, 80% LTV, don't even think about it. In most countries here, as a foreigner, the tool isn't even available. And if you do manage to find a mortgage, it's probably going to be 10% plus. But if you're buying off plan, a lot of developers do offer attractive payment plans. Just make sure you do your due diligence and have a real plan for making these payments. Third is currency. You are converting sterling into local asset markets. So I'd always advise people to model a 10% stress test against possible adverse currency movements before you deploy. So back to the UK, many will say that the UK government is incompetent or shooting themselves in the foot. My personal view is that the policies reflect a wider strategy to cool the housing market and make getting on the property ladder more accessible. This is their political calculation to address the housing crisis that is in the UK. What they don't seem to be doing enough of is actually building new housing supply. Politically, it's easier to tax private landlords than build, and it's certainly faster. Section 24, Section 21, making tax digital, EPCs, CGT, these are not a series of unfortunate policies, it's a program. And the markets I've just described, like in Kuala Lumpur, Bangkok, Phnom Penh, they're running the opposite programs. They're actively competing for foreign capital, and they're building incentive structures to attract that, lowering minimum thresholds and creating visa and residency pathways. One government is taxing capital out, the other is building a system to receive it. And that is the entire decision. And frankly, it's a big part about why I'm so bullish overall about real estate markets in Southeast Asia. If you've spent 20 plus years building a UK portfolio, you didn't build it to watch it become a liability. And now you know what a lot of smart money is doing and why. The next step is understanding which structure fits your specific situation, your tax position, your timeline, and your liquidity needs. This isn't a generic answer, it's a conversation. Just remember, if you want to invest in any property overseas, you will be subject to UK income tax and capital gains tax while you remain a tax resident in the UK. And under the change in domicile laws, you're going to need to exit for more than 10 years before you cease to be subject to inheritance tax. If you are considering exiting the UK, either fully or partially, Rumavi offers strategic advisory services for those seriously considering exiting. It's flat fee, no commission. We work for you, not the developer. The link's in the description for a free introductory consult. I'm Alexander, I'm the founder of Rumavi. Subscribe for more briefings.